Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Phil Palumbo, founder, CEO, and CIO of Palumbo Wealth Management, to discuss the strength of the consumer labor market and sector opportunities within the macro backdrop. Phil, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Thank you for having me.
All right, you got it. Of course, everything's predicated on potential Fed policy here. What's your thoughts in terms of what the Fed is doing as it relates to interest rates and inflation?
I think what the Fed is doing is the right call. I think it was a little too dovish back in December. Markets got way ahead of themselves by pricing in 6 to 7 cuts this year. I really felt all along that wasn't going to happen simply because the target where the Fed needed inflation to be just isn't there yet. And the Fed's telling us until he gets it there, until it gets there, he's not going to start to decrease rates. So I think if anything, what we could see this year is 1 to 2 cuts overall, if that. And a lot of it's going to depend on how the economy is performing.
Right. So outside of the macro backdrop, and we saw this, at least going through this week, is that the market, despite the fact it's not getting its 6 rate cuts, potentially 1 to 3, earnings were quite good. And fundamentally, it kind of makes sense. Some stocks were going up here.
Yeah. So we talked about this about a week ago, the elephant in the room. The elephant in the room was the Fed. But like you said, right, the market smartened up a little bit and went from thinking the Fed was going to cut 6 to 7 times, now more like 2 or 3 times, but you didn't get volatility in the stock market except for today. So you got to ask yourself, well, what's the actual elephant in the room? Well, the elephant in the room really is artificial intelligence and NVIDIA, and that's what's driving overall markets.
Right. Now, in terms of the consumer, right, they continue to perform, right? We've seen the numbers, certainly in retail. Do you think that they still have the momentum behind them, even with savings rates coming down?
Mm-hmm. Yeah, so our forecast is that by the second half of this year, the excess savings from COVID money will be completely dissipated. However, as long as the job market remains tight, as we're seeing today, and consumers have capital, which they will if they have a job, which is the obvious, consumers will be in decent shape. I don't think we're going to see the strength of the consumer as strong as we've seen them over the past year, call it, simply because those excess savings will start to dissipate. But as long as consumers have jobs, they'll have the ability to spend money.
What sectors do you see opportunity in 2024? And my second question to you is the tech trade over? Is there still potential for investment there?
Yeah, so there's a lot to that. And the first part is, so we're long-term investors and we're always looking for opportunities on a daily basis, literally. And a couple of areas that have underperformed over the past couple of years, really 3 areas have been real estate, biotech, and utilities. Utilities, for example, we're seeing them trading at a valuation that we haven't seen since 2008, 2009, right? Historically, their average PE is around 20. Today, it's trading around 15, 16. When we look at fair value for many of the utility stocks, they're trading between 10 and 15% below that fair value. And on top of that, we're starting to see growth in that area over the next 2 and 3 years, simply because we're going to see more use of electricity because of data centers and artificial intelligence. All that would bode well overall for utilities. But in addition to that, on the utility front, renewable energies they made major investments in renewable energy. And what that does for utilities, it makes it a lot cheaper for them to do business, which is helpful for their overall earnings. So we like utilities. On the real estate front, simple stories there. Rates up, values down. On the commercial side, specifically office, industrial, and warehouses, a lot of these landlords are underwater. When they're underwater and they're stressed, it's opportunity for buyers to come in and buy things on the cheap. So we like real estate. The third area we like is biotech. So biotech, same thing, rates up, a lot of cost pressures when raising capital, et cetera, because they're cost-intensive businesses. Now that we believe interest rates are starting to stabilize here, you can see it in the small cap biotech space. It tells us that we're going to see some more money flow into biotech. Artificial intelligence is only going to help the biotech industry. So we really, really like those 3 sectors. I have no idea what they're going to do over the next 3 months or 6 months. I do know over the next 3 to 5 years, I feel really good about that. To answer your question about technology, the simple thing that everybody needs to understand regarding technology is the amount of money that we're going to see that's going to be continued to be thrown at the technology sector, specifically in the digital space. So we went from maybe 200 to 500 billion in spend this year, and that will go to about $8 trillion over the next 7 to 10 years. So if you could only imagine what that means to a lot of these technology businesses, the ones that get it right as far as AI is concerned, I think we're in the first or second inning of this run that we're going to see for some time.
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.